Hey everyone, this is the Trader Investor. Today I had a session where I gave a training to a few folks on using a combination of three different things: the Strat, Fibonacci Retracement, and using supply zone and demand zone to find entry areas, right? Area of value. You hear me talk about area of value a lot. So supply zone and demand zone act as area of value. So find area of value, combine it with Fibonacci, combine it with the Strat to find entries or exits. It works both ways. When I enter, I already know my potential exits. Target one based on the Strat is this. Based on Fibonacci, it's this. Based on supply zone, demand zone is this. Where the three come together, I take my exit quickly. When the three are apart, I might scale out. So there's different approaches, different strategies. I go through that training. So just keep watching this video. It goes into details on how to find those opportunities for you. And at the end of this video, if you have any questions, if you have any comments, let me know so that I can address them for you. And so with that, let's just dive right into the training session. So today we're going to talk about the Strat, supply zone and demand zone. As you can see on my screen, you see the Strat numbers there. You also see the supply and demand zones marked. When I say 1H, it means I have marked it on the hourly chart. It's just for me to easily identify where I have seen that zone. Like if I go to the daily or the 15 minutes, it just gives me a visual, right? That's the purpose why I have it that way. So first, just let's talk about a couple of trades from this past week that I have mentioned and why I would take those exits when I did take them. And then we will dive right into more details. So on Monday, Tuesday, price just was pushing down very strongly. And as I'm looking at my fibs, we're staying below the 78.6. Whatever time frame you're looking at, we're staying below that 78.6, which means more downward pressure. But I like to take trades, sometimes counter trades, when price retraces into the 38.2, does not close below it and just continues up. Usually I like to take it to the 61.8. But however, this zone, the supply zone, was in front of us as we were making this trade. So as you can see, like if we remove hindsight all the time, right? If we look at this, I had already identified this supply zone. So if price comes into that zone, I need to consider exiting. Even though I like to go all the way to 61.8 and to 70%, if price moves too slow for me, I'm exiting. Or if it's end of day, I'm exiting. So we hit that at 11:30 my time, and the very next hour we again played around there. So I was out because we're at the supply zone, thinking that downward pressure, we're at supply zone, and I'm exiting. And I'm sharing this so that you know how I look at supply and demand constantly. In a downtrend, supply zone is stronger. In an uptrend, demand zone is stronger. So if this was an uptrend, I would probably keep a position, like maybe a quarter of my position open to see if it rides up some more, because it has a tendency to just pop through the supply zone, reverse for momentarily, and then blow through it. So that's why I would take it. But in a downtrend, supply zone is my friend. Like that, like I'm taking my exit or my entries based on that. So the very next day, we did not even go all the way to 61.8. You could have said, hey, why didn't you hold this position? But like I mentioned in Discord, I didn't want to hold overnight. I didn't know what was going to happen. And, if I woke up late the very next day and I didn't take my exit on Thursday, all those gains, I would have to give them back. So I don't like giving back gains. And so then the very next day, we rejected at the 50%, right? We wicked above it, but we didn't close anything below that 50%. We rejected it. That's why I said, hey, let's take a put position. But where is my exit? My target was 436 area, but as soon as we got in the demand zone, which I have already identified because of this, then, you know, when price plays around there, you know, for a few hours, and then boom, it comes to that zone, I'm out. I don't want to hold overnight again, especially today's closed, Saturday, Sunday, and then I don't know what's going to happen to Monday. I don't want to give back gains, so I exit there. So
are those manually drawn out supply and demand zones or automatic?
Yes, no, they're manually drawn.
Okay.
Yeah, one, I don't want to trust anything that's automatic, because, you know, this could be very objective, right? So one trader thinks this is supply zone, another trader thinks it's not. So I just know what I want to look at, and I just draw them manually. So this is why these zones are critical. Now that we know these zones, the next thing is, how do we incorporate it with the Strat? This is the discussion for today. Really, we're going to deep dive into what is the Strat and what is supply zone and demand zone. So let's start with the Strat. The Strat is this idea that candles form one of three scenarios. They form an inside bar, which is called a scenario 1 in the Strat language. So an inside bar, I think all of you here know, it is contained within the high and low of the previous bar. That is scenario 1. Scenario 3 is an outside bar, the complete opposite. The high and the low of the previous bar is broken, so on both sides. That is scenario 3. Which leaves the last scenario, which is scenario 2. But the scenario 2 has two possibilities. It can either break the high or it can break the low. It cannot break both sides. Once it breaks both sides, it becomes scenario 3. But then it just can break one side. But remember, a scenario 3 starts as a scenario 2 and ends up being a scenario 3. So if you look at the first hour bar of Friday, we opened, pushed up, creating that 2, scenario 2, and then we closed down, making this a scenario 3. So that's what these scenarios are. 1 inside bar, 3 outside bar, a 2, one of the sides broken. And for me to make it easier for me to see, did it break the low or the high on a 2, I just put, if I put a 2 at the bottom, blue 2, it means it broke the high. If I put a 2 at the top, red, it means it broke the low. It just, for me, it's just a visual thing to help me see that. So far, so good?
Yes, sir.
All right.
Yeah.
Now, the big question comes, how do you trade this? And, you know, the term that they use is actionable signals. What are actionable signals and how do you trade this? I like to combine them with, like I said, with demand zone. I like to combine them with demand zone and my Fibonacci. That is all you see on my chart. You don't see anything else on my chart. Is this combination. My Fibonacci tells me where am I going to see exhaustion, because between 61.8 and 38.2, this is my sweet spot to enter. If I get a rejection in between, I'm entering, which is what we saw Friday. We got rejected at the 50% at the close of Thursday and at the open of Friday. And when you get this rejection, then you have a possibility of a trade. Now, in the Strat, there are a few actionable setups. There's reversal setups and continuation setups. Reversal setups are much better, more accurate, but all setups are possible. And then there's this thing called PMG, pivot machine gun. What that is really a series of continuations that finally get broken to the opposite side, right? Continuation 2, 2, 2, 2, 2, 2, 2, 2. So this is a continuation to the downside, which finally breaks to the upside. And the magnitude is your first target, which is the high of the previous bar, right? And so that's always your target one. A lot of times you will see price stop there and don't want to go to targets 2, 3, 4. So keep that in mind. It doesn't have to go all the way, but what a pivot machine gun says is once you break the opposite side, it has the potential to go all the way down to where that PMG started. That's what PMG is. But this is really not the key part. For me, the key part is reversals and continuation. And reversals, and the way I look at reversals, this is also what the Strat teaches, is look at full time frame continuity. The idea of full time frame continuity is your higher time frames are all aligned going in one direction, and the lowest time frame for your pull the trigger enter trade setup is going the opposite direction of your higher time frame. So that gives you a fantastic opportunity. When the monthly is up, weekly is up, daily is up, and the hourly is down, you wait for the hourly to come back to that full time frame continuity direction, come back up for the rest of them, and you just ride it to the next target. So that's what full time frame continuity means. And reversal, a lot of people talk about reversal. Hey, let me pick the top, let me pick the bottom. That's not what this reversal is about. If you follow full time frame continuity, the reversal comes at the lowest time frame, going in the opposite direction of your 3 highest time frames. And when that lowest time frame aligns itself with the highest time frame, that's your entry and you're ready to go. That's really what full time frame continuity means. So then, if that's the mindset, what are the possible entries, and what tells you that the lowest time frame is done, making its pullback and is now going back in the direction of the rest of your time frames? So there is a 2-1-2 reversal, meaning that a 2 followed by a 1, which is that inside bar, that's scenario 1. And then when you break the high of the 2, or you break the low of the 2 for bearish, is when you enter. Knowing that you could stop at the low or high of the previous 2 as your target. You could stop there or you could continue to go. The stronger your higher time frame trends, the more likely you have a chance to keep blowing through different highs, and you're just going to keep going, which is great. That's when you create the pivot machine guns, right? You have a reversal aligned with your full time frame continuity. You just keep going 2, 2, 2, 2, 2 to the upside, or 2, 2, 2, 2, 2 to the downside, and then you get a break again, another pullback to stop that trend. So after the 2-1-2, there is also a 2-2 continuation. No matter what the third bar does, if you have a 2, as soon as you break the high of the 2, that's your entry, and that previous bar high or that previous bar low becomes your target one. And then you have the 3-2-2 continuation. The 3-2-2 is really a 2-2, with the only difference is that previous bar where we didn't care in the 2-2, in this scenario you want it to be a 3. And one thing I want to mention, when you don't see a color, this is how I'm looking at it, right? This is why you see my logo on here. This is how I draw it. I don't care which direction these two are, whether they're red bars or green bars. As long as I'm following my full time frame continuity and I get this 2-1 and then 2, which is breaking the high or breaking the low depending on the direction I want to go, that's the important part for me. That's the color that I'm looking at. So I don't care about whether this 3 started down here and ended up here, or started up here or ended here. It really doesn't matter to me. And then another thing I want to mention, in a 2-1-2 reversal or a 3-1-2 reversal, if I'm bullish, I would really like the 1 to be as close to the bottom as possible, because that gives me a lot of room to go up. Because if you look at the bearish signal, if I wanted to take this to the upside, my target is really right there, and that's not a fun place to be, right? You're in and out in seconds. I don't like scalping, but even if you're scalping using the Strat on your 1 minute chart, you don't have any room. So that's why I like it to be as high as possible for bearish, as low as possible for bullish. Same as you can see here in the 3-1-2. Not that it doesn't work if it's higher, but this is my chart and this is how I trade it. If it's down here, I take the signal. If it's up here, I don't take the signal. And if my full time frame continuity is bullish, I don't take this signal when it's up here. So a 3-1-2 and a 2-1-2 are very similar. The only difference is what bar you started with. So they're exactly the same. Then you have a 3-2, which is very similar to a 2-2. But in a 3-2 scenario, I don't know what my next target is. A lot of times I don't know where my next target is. And finally, you have the 1 bar reverse rev strat, which is a 3. And if you look at this bar here, this 3, as soon as you break the high of the previous bar, so what that means is you open here, you go up, and when you're coming back down, if you're breaking below that high, you take this trade all the way down, right? That's what the idea of the 1 bar ref strat is. This 3, as you see it forming, you take it. A little tricky, right? You take it and you could say, hey, at the low of this bar is my target 1, at the low of this bar is my target 2. You could do it that way. These trades, I don't like to take them a whole lot because I trade the hourly. I really want a lot of movement, right? I'm not after a small movement where I take 100 contracts and I'm in and out. I prefer to just take 20, 30 contracts and just play it this way because my stops are a little bit wider. I'm looking at supply zone, demand zone for my exits. So if we come back to actionable trades, the last one, as I said, is continuation. Continuation meaning everything is lined up. Your full time frame continuity is lined up in all time frames, including I pull the trigger time frame. For me, it's at 1 hour. So when they're all lined up, when the daily, the weekly, the monthly are all green, I take a green 1 hour continuation. Or if they're all red, I take a red 1 hour continuation.
I got a quick question about the 3-2.
Okay, this one here?
Yeah.
Okay.
So I'm familiar with the Strat. I'm just getting extra knowledge here. But the 3-2, I know Sarah, she say like it's a continuation for her, but I know some people say it's a reversal. And when I got in plays on the hourly chart, I took a 3-2 and it just like went in my favor. But sometimes like that 3-2 really go nowhere and reverse back up.
Yeah. So
what do you consider it as?
I think that's a very good question. The way you should really think about this is, what is your full time frame continuity? That's the key part. If everything lines up, then this could be your continuation, right? You see, okay, I missed the reversal. For example, I missed the 2-1-2. What is my next entry? Well, here I just got a possibility as a 3-2, right? That's one way of looking at it. I don't think it's wrong to say it's continuation. Neither is it wrong to say it's a reversal. Either way is fantastic. But it all depends on your full time frame continuity. So if you missed a reversal, you treat it as continuity. If you didn't miss a reversal, you can treat it as the first entry reversal. But if you look at price has been, let's say coming down, and you get a 3 here, right? If it's all been red, except this 2 now takes out the previous high, it becomes green. You take the 2, that's a reversal, because it's both of these will have to be green, right, in this scenario. But in this scenario, if it's going up, and then this 2 maybe starts down here, maybe it's like this 2. Maybe you think it's a 2 down and it's your pivot machine gun, but it starts as a 2 down and then it makes a 3 up, then a 3, and then you take the next bar, which is a 2 if it takes out the high of the 3. So it all depends on where that formation happens. Yeah. But that's good. So any other questions before we move on to clarify?
Yes. Which one would you say is best suited for like a 30-minute scalp, and what time frame?
Yeah, so all of these work exactly the same way no matter the time frame. What the difference is, your target gets wider as your time frame goes up. So if you're doing the 30 minutes, because you're looking at 2 bars, your first bar high becomes your target in an uptrend, right? Or your first bar low becomes your target. If you're looking at the hourly, then you're combining those 2 30 minutes, and so you get a little bit further out exit. But what that means is your stops are also wider. So it all depends on your preferred pull the trigger time frame, but the way you play it is exactly the same. But and to answer the question a little bit differently, the best entries are reversals. Those are the best entries. But do not attempt to pick tops and bottoms. Only do reversal in alignment with your full time frame continuity. Really, that's what it's about. When your higher time frames, and for me, higher means the daily, the weekly, and the monthly are aligned. When the hourly is misaligned, I love it, because now I'm waiting for that hourly to align itself back and join the family, right? Because the kid is going astray. That's how I'm looking at it. And then it eventually decides, hey, I better come back to my safety zone. I better come back to family. This is how I'm looking at it. And so when that happens, when that kid joins the family, it's time to enter in the direction the family is going.
Thank you.
Yeah. So now we can, anytime you have more questions about the actionable setup, I can bring back that image. But here, as you can see, on Friday, right, these are good examples. This 3 actually started as a 2 up. If you had nothing else in this chart, if you didn't have fibs, if you didn't have supply zone, you would enter here to go long. You say, whoa, continuation. 2, 2, 2 continuation. I love this continuation. I'm going to take it. This is why you don't enter just on one signal. My goal is to help you stack the odds in your favor. You combine everything. When everything lines up in your favor, you take the trade. When that happens, Carmelo, as you will see, the hourly confidence is when everything lines up and it's stacked in your favor, you take the trade, you can shut off your computer, go away. You have no fear in this trade. You've done three things. One, you've managed your risk. You say, if this thing goes to zero, do I lose my house? Right? You got to answer that question. Do I lose my mortgage payment? Because if that's what you're doing, right? And I'm not suggesting that's what any of you here is doing. I'm just saying this is how the mindset has to be. So if you've managed your risk, the 1 hour doesn't scare you. A lot of people are scared because, like, if I walk away, I don't know what's going to happen. That means their position size is wrong. So that's one. The second thing you have done is you have analyzed your charts, you have done your studies, and you said, hey, I believe it's going to go in this direction. You're not predicting, you're only anticipating. Right? You're anticipating it's going in that direction. Why? Because full time frame continuity. Your monthly is an inside bar, but it's a down bar. Right? So if you look at your monthly, it's an inside bar, but it's a red bar. So okay, that monthly is down. I'm looking at everything else going down until they prove me wrong. Weekly, it got rejected at the 70% and it's a down 2 weeks down, or actually 3 weeks down, even though this was a red day or red week, but an inverted hammer which collapsed, right, 2 weeks in a row. Here's where that Fibonacci comes. Where did this get rejected? At the 70%. So as soon as I break the low, right, it started here, it went up, and then as soon as it breaks the low, here's your 2 reversal. Right, here's your pivot machine gun. I don't like pivot machine guns with only 3 bars. I like at least 5 bars, but you can kind of think of it that way. You have 2 up, 2 up, 2 up. You started with an inside bar and then you formed a 2 down. Well, you know, here is your 2-2 reversal, or here's your pivot machine gun entry as soon as you break this low. So on the weekly, you break this low and then you start to walk it down, because then your next target is this low. All right, the low of each previous bar is your target. So boom, if you're in on weeklies, you're probably out 100% of your position. This was a fascinating move. You go from 448 to 440, you're just killed it right there. Right? Your options have more than doubled. And then you can target this next one. If you're not fully out, maybe you have 10% of your position, you know, with tight stop, you want to see, let it run. That's okay. So then your weekly is also down. Your monthly is inside but down. Your weekly is a 2 down. You go to the daily. What is the daily telling me? The daily is telling me I'm confused because I have a 3, a 1, a 3. Right? So the daily is saying, hey, I'm really confused. I don't know what I'm doing. But when you are looking at the overall picture, just for one day, it gave you a fake, hey, I'm going to make you think I'm going to go up. Right? This is a bull trap. I'm going to make you think I'm going to go up. I'm going to go from 38 to 68. I'm going to make you think that way. But boom, it reverses the next day. So when you're having this kind of crazy weeks, even if you have swing positions, it's good to get out, at least majority of them, that you're out. So now that we understand monthly is down, weekly is down, daily is down, because daily you can see overall is down, and then it's just been playing around here. I pull the trigger. This is when I make a decision. I say, oh, okay, you know what? Everything is pointing down. So this bar, when I gave you guys the signal to enter this bar, I entered it late, but I was still confident 436 was my target. 436 was my target, but I knew I could stop anywhere here. And I wasn't going to hold overnight. So, I make 30%, I'm out. Do I want more? Yes. But you know what? I'd rather make 30% than give back 100% of that position. So this 3 is actually a good reversal, right? It's a good reversal.
What was your contract for? That was for next week?
It was for next week.
Okay.
I personally don't like to play 0 DTEs. I like to give myself time. Here's why. I think we all have our strengths and weaknesses, right? One of the things is, if I'm convicted of my position, I don't like to exit, even if it goes against me, because I still believe. So if I want to take this position, right, as soon as this 3, this 2 up becomes a 3, I'm taking this, which I took somewhere down here because I had the 50% rejection. But as soon as I take this, if price decides I'm going to stay inside the supply zone, I'm going to stay below the 70%, I'm not exiting, right? So that's why I position it accordingly. If you have a tighter stop, you can increase your position size, but then you also better monitor the charts and get out very quickly. I think that's a key part there.
Understood.
And so you get a reversal, you take it, right? So this is how, now I'm showing you how I'm combining it, right? So now that we know actionable signals, when we add the Fibonacci, we know, okay, where are we getting rejected? For me, my sweet spot, and let's see if this refreshes quickly. On TrendSpider, I like the way they allow you to kind of highlight your fibs. So see how it colors it here for me, 38 to 61.8. This is my sweet spot. When price comes down and rejects this area, I'm happy. I'm loading up full size when I get this rejection. If I am entering a rejection at the 23.6, I'm doing half position size. Sometimes I might even just do 1 or 2 contracts. But these ones are great rejection areas, right? I am very confident between green to green. Green to green is my sweet spot, but I get rejected at 70, 78.6. I will also take them. But green to green is my sweet spot. So I know I've drawn the supply zone. I've drawn the demand zone. I know my entries and my exit ahead of time. Because I get the rejection, odds stacked in your favor. Remember that. Supply zone, Strat, Fibonacci. All 3 lined up. 4, full time frame continuity. 4 things lined up for you. There's no reason not to take that trade. Unless fear kicks in. Fear only kicks in if position size is wrong. And as you're learning something new, my suggestion always is only do 1 contract. You don't have to go from 442 to 437. You can go from 442 to 442 and change, 50 cents move on a delta 50. You've made 25 cents or so in that contract. The goal is to learn, not to make money, right? Initially, that's why you only do 1 contract, because you're learning something new. You're learning the intricacies of that setup. Just do small position. If it goes to 0, it doesn't matter. Just take whatever it gives you. When you're doing 1, you don't have the luxury of saying, hey, I'm going to take some position off here and I'm going to keep riding it, right? So you have to say, hey, where is the right exit? I'm just going to take that exit. And when you're looking at these setups, the next bar after your entry signal is your exit target. That's magnitude 1. So as you're looking at those magnitudes, take those exits. That's the key part. So now that we have added the Strat and Fibonacci, how do we draw supply and demand? I think this is the next question. So let's come down. Let's come down to, this bar here. Let's come down to this bar. So when I know everything is in the downtrend, I have to identify a supply zone, because that's an area where I could potentially stop. So don't mind this demand zone because it's not drawn yet at this time frame, right? It's drawn later. So the way I think of supply and demand is, where has price turned and resumed either the previous direction or created a new direction? What I mean is, we're in a downtrend, and in this downtrend there was a rally. After the rally, price dropped. So where did that take place? So I look at that and I take from somewhere from the open to the high of that zone is what I call the supply zone. So this is drawn a little bit higher. Oh, I don't make this glass probably why. So here, from the open to that wick high, and then it reversed. So there's no scientific way. You can even say I get this rejection wick. That tells me that's the supply. You can also draw it that way. Either way, it's not wrong, right? So as soon as that rejection is, let's actually take a step back and say, what is supply zone? What is demand zone? Why are they created? So a supply zone is created when institutions want to take a position to the downside, but all their positions don't get filled. They don't want to chase. They don't like chasing. So they're saying the maximum I'm willing to take this position is inside this box. We don't know that until it has happened, which is good, right? That's the breadcrumbs we want to follow. So when we see this is the area that they have blocked. They say, if it goes beyond that, I'm not taking a position. So what it means as a supply zone is, the next time price comes back here, it collects the remaining orders and then takes the price back down. So that's why it's important to look at your long-term direction. When you have full time frame continuity, everything is pointing down. When you come to a supply zone, oh, they're wanting to go down. They missed the first chance. They're taking it again here. And for me, once it has happened the first time, right? This is not the first time. This is when the zone is created. But the next time I enter that zone and out, I am done with this zone. I'm redrawing it. A lot of people like to keep it. A lot of people like to trade it even the third time. But it gets weaker and weaker as you retest it. So I just say, hey, the strength is the first time it goes there. That's the strongest it is. That's when I take it. So I've drawn this. Now it's a waiting game. What do I do next? So here's how I wait for it. Green to green, sweet spot, remember, but now this is the reverse. So, but what I have as a strategy is, when I retrace above the 38, I will target the 61.8 and take a position, a quick position in and out, because this is a counter trend, right? If it's full time frame continuity, I'm not going to limit myself to 61 because I know the child just came back to the family. We're just going to keep writing this back up. But if we're in a downtrend, I just want to take a quick in and out, like some between 25 and 50% gain, That's good enough. So here, that's how I'm preparing, right? So I've seen the zone. I have my retracement. Now, because of this guy, that's my retracement. But hold on. If I, this is where I was until I have a turning point. I don't know. This is where I was. I got rejected at the 50. I'm waiting. I don't take this drawing yet. So here I see, oh, okay, I see a reversal. So then I can extend this to the low point, and then I take this. I'm waiting for this to trigger. There it goes. So this bar closed inside. I'm wanting to enter. There's two ways to enter: at the high of this bar, or a little bit riskier is any time the next bar opens, but tight stop. So you take it. We reach the supply zone, right? Remember, I take this trade, I reach the supply zone right here at the 50%. The next hour, it fails to go to 61.8. I'm out because I'm not holding overnight. And I know this is a supply zone. Because everything is down, supply zone is strong, I'm out. But while I'm doing this, I have drawn my demand zone. Again, price came down. They wanted to take price up. They didn't get all their orders filled because this is a turning point. So they might come back and take more positions to the upside. I'm still biased to the downside. So at demand, I'm not loading up the boat to reverse, right? I'm not playing that reversal when I reach demand. At least I'm considering taking an exit when I'm at demand, right? Same way here. Remember when I said I'm going to play reversal temporarily 38.2 to 61.8, but I'm at supply zone, so I'm exiting at supply zone. Same thing here. I'm exiting at demand zone, but in this scenario, I leave a position open. If it wasn't this long weekend, I would normally keep a portion of the position open for Monday. But for now, demand zone at least is target 1. At the very minimum, that's target 1. And then, as you can see, we danced around, and then we touched that zone. We touch that zone and we exit. So this is why it's important to identify them. So anytime you have an up move that goes the opposite direction, that's your supply zone. You have a down move that goes in opposite direction, that's your demand zone. Right here we had a demand zone, but we blew right through it. I like to color code them so I know what I'm talking about here. So as you can see, this was the zone, but we jumped right over that zone. We tested that zone and we just kept blowing through it. So like I said, once that zone is taken care of, I'm not cluttering my drawings. So we have a zone here which I don't believe is going to hold anymore, but you can leave it if you like. We have a zone up here, but another one that I have not drawn, hopefully you can see, and an up move that goes down. Here's your zone here. Here's your zone here. So again, maybe the next time is we don't stay here, we come up here and then we collapse. So now you have all combinations from my chart. The zone, supply or demand, Fibonacci, the Strat, and the full time frame continuity. You combine these 4 things, you're golden. But practice, so you can feel comfortable when is it a good time to take a trade. Right? a lot of people get trapped in thinking, oh, I've picked the bottom. I'm going to take this trade because it was up 2 days in a row. It's beautiful. I'm just going to keep holding to my position. But then price collapses on them. So make sure that you're practicing and also looking into the bigger picture, right? The bigger picture.
Which indicator do you use to mark the candles for the strat?
Oh, I created my own, but Carmelo can probably help you. He can put it in the Discord, Carmelo, if you have it. There's a Trading View has its own strat indicator.
Okay, yeah, I'll do that.
Yeah, please. Yeah. I'm just picky, right? That's why I created my own. This is not the best.
If I could, I would. I'm not as savvy with the creation, but if I knew how, I'd definitely make my own.
Yeah, I just like to play around with the coding. If I want to change something, I have the flexibility to change it, and so on.
That's awesome, because then when you customize it, you know exactly what it's doing because you're the one who created it.
Yeah. So, remember, the monthly is really in an uptrend, only pulling back above the 23.6. So it's really not fully a bearish market, but we could turn bearish. So keep that in mind. And then there's this idea of broadening formation, but I think we should leave that for another day. That broadening formation is just when a 3 is formed. You get this in chart pattern. It's called a megaphone. Right, when you get a megaphone, usually people take those trades. Oh, we just broke this trend line. I'm going to enter. But you know what happens is you break that trend line and you reverse back. You break the trend line, reverse back. So I don't like to enter break of trend line, break of support resistance right away. I need to let the chart tell me. If I break this trend line and then I come test it and struggle to break back into the previous direction, yes, this is a beautiful entry. But that's not what happened. You break the trend line, immediately reverse twice, right? 2 months in a row, you come to that trend line and say, you know what, I'm not going to let you make a new low. That's not the intention, right? The wick might make a new low, but the close doesn't allow you to make a new low. And right now, because we have a 1, April historically is an up month, historically. So we could see the next 2 weeks turn this one into a 2 up. Right, but again, keep in mind that this previous high could be, that's this previous month's high could be an area where we have an issue. But if this becomes a 2 up, yes, we've broken above it, then we can target, these highs here, this January highs. Once we break this January highs, we make new all-time highs and then see where it goes from there. All right. Any final questions? We can do another session next week, so don't worry about things that you've missed or things you want to, think about and then review again next week. Don't worry about that. We can do it. But any final thoughts for the next 2 minutes or so?
So I got a quick question about Airbnb for next week.
Okay.
I'm gonna tell you what I see, and can you tell me what you think about it?
Okay. Let's bring it up here as soon as my chart cooperates.
I know we got earnings coming up on I think it's the 14th next week or the 12th or next month. Yeah,
So
May 12th.
May So if we look at the daily, yep, May 12th. Okay.
Yeah.
What
So-
time frame do you want me to go to?
So I'm looking at my phone on TradingView. So I'm on a monthly chart right now.
Okay.
So the monthly chart, it went 2 down, and then it went a slight 2 up.
Yes.
And then for the weekly chart, that it went 3, 2 down, but the 2 down is green. So it looked like it hit the trigger and it did a little pullback for corrective activity, and looked like it's about to go 2 up again on the week.
Okay.
So I drew a fib on the weekly chart, and my target, I was looking at 180 calls for, I think, the 29th, 180 or 185 calls for the 29th. And when I scroll down to the daily, it's a shooter. So, like I said, I drew my fib on the weekly chart just for that one current candle, that's the most recent candle. And then it looked like it's a shooter on the daily, which looked like to me that it's going to retrace to around like 165-ish area. And I was going to get an entry off that 165 area, off a reversal, and then entering 180 calls or 185 calls.
So a couple of things I want to mention is way out of the money calls are very dangerous. Those are the calls that 95% or more of the time expire worthless. So consider adjusting your position size and getting closer to at the money. Yes, they're sexier because the gains are percentage-wise much significant, but they're also riskier. So with that said, let's look at your 165. How did you come up with the 165? I want to know where you drew your fib from. So for me, what I see is this swing low to this swing high.
Which
this is a weekly.
So I drew it on. So I did it on the daily chart. Actually, sorry about that. The daily chart. So the most recent low to the most recent high.
So this most recent low to
before this week though. Maybe I did it wrong. So starting on the 11th, I drew the fib from the bottom of the 11th to the top of the 14th.
So here's the bottom of the 14th.
No. The bottom of April 11th to the top of April 14th.
Okay. Yeah. So I cannot say right or wrong on these fibs, right? Because a lot of people have different styles of drawing fibs. So I'll take out my weekly just so that we're on the same page. So 165 area is your 50% retracement. So what you're saying is if we come down to this zone, right, like for me, green to green, you want to take an entry.
Right.
Nothing wrong with that. Here's what I don't like about this setup. This is very choppy. 1 week up, 1 week down, 1 week up. Right? Very choppy. Can you tell me the trend, the weekly trend? Can you tell me what it is?
Look like it's in a downtrend.
It looks
kind of neutral.
Exactly. When it's neutral, I don't mess with it. There are so many opportunities out there. I'm like, okay, I'm seeing this. I don't like it. I'm going to the next one.
So seeing as though on the previous week you got a 3, which triggered the month on the 2 up, and then you got on this current week a 2 down and it's green, and it's close to taking out that 3. You don't think that's a good play?
Again, I'm not saying it's not a good play. I'm just saying for me, I don't see enough of a conviction stacking the odds in my favor.
Yeah.
I don't see, like here, this was a clear uptrend. But right now, it's a clear, I don't know what trend I am. Yeah. So, but there's nothing wrong with that, right? Because if you start with your daily, and you use your daily as your highest time frame, and then you go down to the 1 hour, to the 30 minutes, to the 5 minutes, you'll have some entries. But for my style, because I do the hourly, I want to see a clear indication, and I want to see lineup. Here, even right now, the monthly is red, the weekly is green, and the daily is red. That's a confusion for me.
Okay.
Yeah. So anyway, if you have any other thoughts, keep them in mind. I have to run.
I did have a question, Ben. Are you able to send over the breakdown sheet you created, and also the recording when it's ready?
Yeah, I can do that.
Okay, I want to study that over this weekend.
Yeah, no worries. I'll send it over.
Thank you.
All right. Take care, everyone. I gotta run.